December 24th, 2024. While the world was looking elsewhere, a critical fracture appeared in the precious metals market. On that day, the gold-to-silver ratio plummeted to 62.35, hitting its lowest level since July 2014. This wasn't just a statistical blip, it was a reversal of a massive trend. Only months earlier, in late April 2025, that same ratio stood as high as 106. The correction has been violent. Throughout 2025, silver has surged between 140 and 150% year-to-date, fundamentally outperforming gold's own impressive 70% gain. This isn't happening tomorrow. This is happening right now. In the next 13 minutes, I'll show you why this 62.1 ratio is the red alert major funds are using to quietly exit gold. But why are they moving now while the media is focused on the Sensex drop? Let's look at the data. Go verify this yourself. The pattern is already set. December 26th, 2025. The BSE Sensex falls 367 points as the Nifty slips below 26,050. While retail investors watch the boards in a panic, a different story is unfolding in the commodities vault. By December 23rd, silver reached a staggering $70 per ounce. The reality is that the supply side is breaking. Since 2021, cumulative silver deficits have surpassed 25,000 tons. This is the result of years of structural imbalance. Not sold, not exported, stockpiled. Let me show you what's already begun that the media isn't covering. Industry disclosures indicate a shift even if full numbers aren't publicly available across every jurisdiction. The gold-to-silver ratio has collapsed from 106 down to 62 in a matter of months. Available information paints a clear directional trend. But what happens when the slush fund of global inventory finally runs dry? This isn't fear-mongering. This is pattern recognition. Phase 1. The industrial vacuum. To understand the 62.1 alert, you have to look at where the metal is actually going. This isn't just about jewelry or coins anymore. Industrial consumption now accounts for more than 60% of global silver demand. We are witnessing an irreversible absorption of supply. The primary drivers are the pillars of the new economy: AI data centers, electric vehicles, and solar panels. This is the triad of the modern age: AI infrastructure, 5G networks, and solar grids. Public reports have made one thing clear. The demand from the photovoltaic sector is now so high that companies are desperately reinvigorating silver thrifting efforts. They are hitting psychological price barriers that were once thought impossible. But the technology requires the metal. There is no substitute. Industry disclosures indicate a tightening supply that has led to an estimated 2025 silver shortage of 3,660 tons. That is between 117 and 149 million ounces of metal that simply does not exist for the market to buy. This isn't a projection. It is the physical reality of our manufacturing requirements. Analysts have noted this tightening supply throughout the year, marking a trend that is unmistakably bullish. Not hidden, not denied, just unspoken in the mainstream financial press. When you see the kinetic growth of automated EV assembly lines and massive server farms, you are looking at silver disappearing from the vaults forever. This isn't happening in a vacuum. The industrial machines are inhaling the global inventory at a rate the mines cannot match. Go verify this yourself. Look at the industrial output numbers versus the mine production. This isn't fear-mongering. This is pattern recognition. But industrial demand is only half the story. Here is where it gets darker. The financial side of the equation is about to catch up to the industrial reality. Phase 2. The ratio compression. For decades, the gold-to-silver ratio has been the ultimate compass for the professional macro investor. Historically, we have seen this ratio reach as low as 15.1 during major global market resets. We aren't there yet, but the momentum is undeniable. Over the last 5 years, silver has seen gains of 215%, while gold has climbed 180%. The gap is closing. On December 22, 2025, gold broke through the $4,400 per ounce mark. But while gold was making headlines, silver was breaking barriers. In 2025 alone, silver smashed through $50 in October, $60 in December, and is now aggressively approaching $70. Available disclosures point in a single direction. The ratio is being crushed by a silver market that is finally waking up. Industry reports regarding historical precedents show that when these resets begin, they move with a speed that leaves retail investors behind. Even without full figures released from every private vault, the trend is unmistakable. This isn't about speculation, it's about the math of the reset. This isn't happening tomorrow. This is happening right now. The market is correcting a multi-year undervaluation in real time. Not slow, not steady, but explosive. We are seeing a compression that hasn't been witnessed in over a decade. The split between gold and silver price action is creating a window that institutional players are diving through. They said the market was stable. It wasn't. And that's when the illusion breaks. Go verify this yourself. Look at the historical charts of every major monetary reset in the last century. The pattern of ratio compression is always the lead indicator. But what no one noticed was how the institutions began to change their behavior behind the scenes. That's where the real story begins. Phase 3. The institutional exit. While most people are distracted by the daily noise of the stock market, the big money is moving. Global silver ETF holdings surged to 1.13 billion ounces in 2025, a position now valued at over $40 billion. The velocity of this move is what should alarm you. By mid-2025, 95 million ounces had already flowed into ETFs, surpassing the entire inflow of 2024. This isn't retail buying silver coins at a local shop. This is institutional positioning. Even the major banks are signaling the shift. JP Morgan forecasts that gold demand will continue to push prices toward $5,000 per ounce by the end of 2026. However, the projected upside for silver is even more dramatic. Analysts are setting silver targets for 2026 in the range of $75 to $100 per ounce. Not a dip, not a correction, but a structural re-rating. This is what an exit looks like. Major funds are moving out of gold positions to capture the higher percentage gains promised by the silver ratio compression. They are following the yield. The clock is ticking for those holding paper assets. Industry disclosures indicate a shift in how these funds are hedging against the volatility of the broader market. What we do know is enough to reveal the pattern. Institutional capital is seeking the safety of the industrial metal with the highest growth potential. The banks know it, the funds know it, and now you know it. This isn't happening in a hidden room. It's happening in the transparent holdings of the world's largest exchange-traded funds. Not hidden, not denied. Just unspoken in the news cycles that focus on the crashing Sensex. But there's a catch that the banks aren't telling the retail public. This brings us to the pivot. We are seeing what experts call a vacuum effect in the heart of the world's financial centers. The London silver markets have already unwound a year's worth of drain, with 212 million ounces of repletion occurring as the physical market struggles to keep up. The slush fund is empty, and the ghost inventory is being called in. Available information paints a clear directional trend. The supply that was once sitting in London and New York is being sucked into industrial and institutional hands. However, there is a warning you need to hear. Analysts have noted that prices may have taken the market too high too quickly, and industry disclosures indicate that a period of consolidation is likely in early 2026. This isn't a sign of weakness. It is the market breathing before the next leg up. Don't be average. Don't wait for confirmation when the trend is already this established. The window to prep for the January shift is closing. This is where the strategic actor separates themselves from the passive observer. The pattern recognition is clear, the vacuum is real, and the inventory is vanishing. What does this mean for you? You have to understand the scale of the game being played. The silver market is roughly 1/10 the size of the gold market. That single fact makes it susceptible to massive, explosive price swings when institutional capital moves. Available disclosures point to a single reality. When the funds move from gold to silver, the impact is magnified tenfold. We are looking at a perfect storm in 2026. Inflation expectations and central bank rate cuts are the primary drivers for this next phase. Even as they pivot, J.P. Morgan projects that central bank gold buying will average 585 tons a quarter throughout 2026. This creates a rising floor for all precious metals. But silver is the one with the ceiling removed. This isn't happening tomorrow. This is happening right now. We are looking at a potential shift in market dynamics, not just a cyclical turnaround. The 62.1 ratio is the last exit before the bridge to much higher valuations. Industry disclosures indicate a shift in the global monetary landscape where hard assets are the only reliable sanctuary. This isn't fear-mongering. This is pattern recognition. When you see the central banks stockpiling and the industrial demand accelerating, you are looking at the end of the era of cheap silver. The consequences of ignoring this pattern will be felt throughout 2026. The information is public. The pattern is visible. The decision is yours. So, how do you prepare for the January shift? Industry experts suggest that the most effective way to manage the inherent volatility of silver is through systematic investment plans, or SIPs. This allows you to build a position while the market consolidates. Available information suggests that target prices for this January preparation period are in the $75 to $80 range. Analysts have noted that the strength of the trend could push silver toward a target of $100 as the year progresses. This is not financial advice. This is pattern recognition. Industry disclosures indicate a shift in how retail investors are being advised to enter the market, moving away from high-leverage paper and toward more stable, long-term accumulation strategies. Don't wait for the headline. Be the headline. Go verify this yourself by looking at the price targets being set by the major trading houses. The trend is unmistakable. Whether you are looking at the industrial demand or the institutional flows, the preparation window is here. Not sold, not exported, stockpiled. That should be your mantra as we head into the new year. The clock is ticking on the current price levels. The environment rewards the disciplined. We have seen silver's gains reach 215% in just the last 5 years, outstripping almost every other major asset class. Currently, the ADX index, which measures the strength of a trend, is nearing 32 for silver. In technical terms, that signals a remarkably strong bullish trend that is far from over. This isn't a guess. This is the math of the market. History doesn't repeat, but it certainly rhymes. We are seeing the same patterns of ratio compression and industrial shortage that have preceded every major silver bull market in history. Available information paints a clear directional trend for those willing to look past the daily noise of the Sensex. The ratio is 62.1. The alert has been sounded. The question is whether you will act on the pattern or wait until it's too late. The pattern recognition is your edge. Use it. This is a developing story. Subscribe now to track the 62.1 ratio compression as we enter 2026. Don't miss the next critical update. Leave a comment below. Are you exiting gold for silver this January? Let's discuss the strategy. The clock is ticking. I'll see you in the next one.